I have a lot of questions. I usually receive a lot of questions regarding to, what capital allocation strategy would you advocate for a permanent capital vehicle or a vehicle of a sort that invests in the autonomous economy. And a lot of people, when they think about capital allocation, they think about debt and equities. They think about the efficient frontier, balancing portfolios. We think about it differently. We see four strategies in our allocation model. One, we talked about direct asset ownership. So direct asset ownership is literally, it's an infrastructure like investing. You own the physical robot, or facility, and you lease them back to the operators. So it's predictable yield, the real collateral. The only risk that you are taking is the credit risk of the operator and the technological obsolescence. So these are the two things that we look at. From the operator perspective, we're not going to fund somebody who didn't start in the process. So we come in and we can help them scale. So let's say they have already started the process of creating an autonomous process within their overall process. They have a proof of concept and they need capital to grow it. So from an operator perspective, we kind of de-risk it. It's not a greenfield, it's kind of a brownfield investing. From a technological obsolescence, usually things do not renew on a yearly basis. So we have to kind of embed that in our IRR. When do you think we need to get back our money before technological obsolescence become a thing? So I usually use the old adage of, vehicles. For those of you who are old enough, vehicles used to kind of have a life cycle of 5 years, 6 years back in the 90s, maybe early 2000s. So if you buy a BMW, you kind of assure that this model will last you 5 years or 6 years without them coming back with a new model. So that's how, as the analogy that I usually use. In obviously the industrial space is a little bit different, but kind of give you a little bit of a ballpark what technological obsolescence is in a way. Not from a car manufacturing perspective, but things don't get super efficient, by an order of magnitude before your old machine becomes obsolete or valueless, right? So things have to be meaningfully better in order for you to lose value for your investment. So that's on our first strategy of our model allocation. The second one is equity and coordination. And that's, the first, by the way, direct ownership, we allocate around 30% of our portfolio to that. The second one is, is equity coordination. It's actually the highest IRR. This is the highest conviction. It's a high conviction position. These are stakes in company owning the orchestration integration stack. This is the most defensible, position in the overall robotic, stack. Because once they're embedded in the system, the cost of replacing that orchestration is monumental. So switching cost is super high. For instance, it's easy to replace a machine because of obsolescence, but it's not easy to replace the brain that makes your machine works within a certain specific workflow. And margins in these companies, as I mentioned earlier, have around 50 to 70%. Think about them as SaaS margin of a sort. The third model in our asset strategy is a combination of credit and debt. So it's you lending against hardware or against companies, who want to grow in the robotic space. So you're not buying robots and leasing it to them. So you're actually lending companies against a specific portion of their asset growth. They want to buy robots, you can lend them, right? You don't buy the robot, but you lend them, and the collateral could be the business, the operating business, or the asset in itself. And usually you want to lend to companies that have obviously a very good credit and good underwriting, et cetera, et cetera. Then the last but not least, which represent around 20% of our portfolio, these are reserve, opportunistic, pools of capital that we kind of want to have at our disposal at any given time to take advantage of market dislocation. When we say we take advantage of market dislocations, it could be in the physical space or it could be in the pure capital market sense. So either physical space, there's a glut of inventory and the market is pricing those Inventory at below replacement cost. That could be one example when we can intervene and buy the assets. Another example is this massive capital dislocation of the capital market, massive sell-offs. LPs want to exit their position in robotic companies because, as I mentioned earlier, they just have a window of 7 to 10 years, and robots and robotic companies usually needs to be owned for longer than that, and people just want out, and you are a provider of capital and they want a discount and you want a discount and they agree to that discount, and therefore you provide them with capital and you take on that equity ownership. So in essence, we think by having a diversified strategy across hardware, software, opportunistic, and credit, the portfolio will realize a return on invested capital that is actually not correlated with the general market overview or the economic trajectory.